Welcome to the DWS Market update. We have had more than a fair share of auto headlines this year. In the short term, the stocks of car manufacturers have suffered due to the varying tariff threats made by US President Trump. However, a strategic view on the sector reveals that many auto companies are grappling with structural issues. At DWS, we have developed a proprietary balance sheet analysis method called CROCI that allows us to make regional accounting methods comparable. Here, we recently took a close look at global automakers from developed countries. It really shows that European car makers have a lot of homework to do. Backward-looking metrics, such as net invested capital or the number of employees, reflect the former supremacy of European car makers in a global context. Productivity, on the other hand, is significantly below the levels of manufacturers in the US or Japan, a trend that has further intensified over the last 2 years. European expenditures on research and development should not be underestimated by international standards. However, in terms of economic earnings, European car manufacturers are clearly lagging. Unsurprisingly, profitability in Europe is below the international average. This is also reflected by our profitability measure CROCI, cash return on capital invested, which in Europe was only around 0.5% at the end of last year, far behind the other regions. We do observe that, on average, also car manufacturers in the US and Japan are not earning their cost of capital. However, the lack of European car makers has increased even further in the last 2 years. This suggests that well-known issues such as energy costs, labor costs, and bureaucracy are currently making life difficult. We are curious what the analysis of the upcoming annual reports will reveal. That's it for today. Thank you for your attention and goodbye until next time.